Welcome to Distinctive Financial Reporting. In this tutorial we're going to focus on government grants, and government grants refers to assistance by the government in the form of transfer of resources, to an entity in return for past or future compliance with certain conditions relating to the activities of the entity. Okay, so assistance by the government in the form of transfer of resources to an entity in return for past or future compliance with certain conditions relating to the activities of the entity. So the government is trying to coerce the company to act in a particular way by giving it certain privileges in terms of resources so that it can achieve that set objective. Now we're going to look at categories of government grants. Okay, so basically there are what we call asset-based grants, and then we've got what we call income-based grants, and then lastly we got grants related to loans. Alright, now under asset-based grants, the prerequisite is that if you want to for us to account for a grant as an asset-based grant, so we're going to say the prerequisite to account for a grant as an asset-based grant is that the entity should purchase construct or acquire a non-current asset. Right. So as long as the company does not acquire a non-current asset, a grant will not qualify as an asset-based grant. The entity should use the grant to acquire or construct or purchase a non-current asset, and that is the prerequisite for a grant to rank as an asset-based grant. And then for income-based grants, here we're just going to say all government grants which are not asset-based are income-based grants. Okay. And then under grants related to loans, we are saying the government can decide to give an entity loans which are below market rate, and in such a situation these loans should be treated in accordance with IAS number 39, Financial Instruments Recognition and Measurement. So basically we're saying the loan is measured at fair value, and the difference between the initial carrying amount of the loan, that is the fair value, and the loan proceeds received from the government is the benefit received and is treated as a government grant. So we are saying for grants related to loans, you are saying fair value of the loan minus loan proceeds Alright, so the difference between the fair value of the loan and the loan proceeds constitute government grant. If a loan, in this case we are also saying that if the loan relates to income, it should be accounted for as income grant or a deduction from the related expense as with any other income grant. Okay, now we want to talk about the accounting procedure for grants, and for us to do that we're going to draw a table that is going to help us analyze the difference between asset-based grants and the various ways of treating asset-based grants as compared to the different ways of accounting for income-based grants. So yes, there we go. Right, on this side I'm gonna have asset-based grants. Right, so there are two ways of accounting for asset-based grant, and here I'm gonna have income-based grants. Income-based grant. Alright, so here in this session we're going to mainly focus on asset-based grants and uh, asset-based grants and income-based grants. Okay, these two. Um, that's our focus in this lesson. Now we're going to now talk about the accounting procedures that needs to be taken if a grant is asset-based. Right. So one way of treating an asset-based grant is the grant is deducted in calculating the carrying amount of the asset. Right. Now in this case, if you do that, it means that the grant is recognized in the profit and loss over the life of a depreciable asset as reduced depreciation expense. Grant is recognized as reduced depreciation expense. Right. So that's the effect of subtracting the value of the grant from the asset. And another way of recording an asset-based grant is you can choose to recognize the grant as deferred income. That is recognized in the profit and loss on a systematic basis. Over the useful life of the asset. Okay, so those are the two ways you can record your asset-based grant. Now, in both cases, there are current tax effects. So here we're gonna write current tax, and here we're gonna write current tax, so that you see the effect of each way of recording a grant. So we are saying that if you are recording the grant as a deduction from the cost of the asset to arrive at your carrying value, the full amount of the grant is taxable in the year received. Okay. So in other words, we are saying tax allowance. Okay, so this is another important point. Tax allowance is calculated on full amount before we deduct the grant. Take note, we said for us to arrive at the carrying amount, we have to deduct the grant from the cost of the asset. But here we are saying if you want to get your tax allowance on the asset, you have to calculate your tax allowance on the full amount, on the full cost of the asset before we deduct the grant. Okay, and then we are saying for tax purposes, the full amount of the grant is taxable in the year in which it is received. Those are the two important points concerning current tax on there. And if you are recognizing the grant as in other income, as deferred income that is recognized in profit and loss, here we're just saying the full amount of the grant is taxable in the year received. Of grant Alright, so these are the implications of asset-based grants depending with the way you choose to recognize it. Alright, so the next thing we're going to talk about here is deferred tax. Okay. So, if you are reducing the cost of the asset by the amount of the grant, deferred tax will arise due to differences in number one, the starting date from which depreciation is calculated and tax allowances are calculated. So usually these dates are different. The date at which you are calculating your depreciation and the date from which you are starting to calculate your tax allowances. And number two, the depreciation rates and method. um, could be different with the tax allowance rate and method. So depreciation could be 10% per annum, and over 10 years, and then tax allowance could be 20% over 5 years. So those differences could result in deferred tax. Could result in deferred tax. Now, right, if we are accounting for the asset-based, if we are recognizing as deferred income that is recognized in profit or loss on a systematic basis, deferred tax implications may arise in the following cases due to the following issues specifically. The tax base of the grant will be nil. Since the grant was taxed in full on receipt, and we are saying here the cost of the asset won't be nil, so that will result in deferred tax differences. Now the carrying amount of the grant will be greater than the tax base. So obviously the carrying amount will be greater, since the tax base is going to be 0. We'll be having a greater carrying amount there. So these differences will give rise to deferred tax. Okay. Now the last thing we need to talk about there is the repayment of government grants. If it's an asset based, and then we'll talk about it again when it's income based. So I'm just gonna extend my line there. Okay. So if the grant was previously deducted from the cost of the asset, the repayment is recognized by an increase in the carrying amount of an asset thereby reducing the deferred tax or reducing the deferred income by the amount repayable. Okay, so we are basically saying the income that you received in form of the government grant will have been reduced by the amount that you're going to repay on the government grant. Okay, so this applies in both situations. This applies in both situations. So I'm just gonna erase that line there, so that so here I'll just write repayment of government grants. So the repayment is recognized by an increase in the carrying amount of the asset, thereby reducing the deferred income by the amount repayable. Yeah, and then in this in the other situation, we are just saying the carrying amount of the grant will be reduced as well. Okay. Now let's turn on to income-based grants. So income-based grants can be recognized as follows. So the grant is represented by, okay, let me just say, as a credit in the statement of profit and loss. Either separately or under a general heading, such as other income. Another way of treating an income-based grant is the grant is deducted from the related expense. Right, so it's either you represent the grant as a separate line item in the income in the statement of profit and loss and other comprehensive income, or you deduct the grant from the related expense. Those are the two ways of treating an income-based grant. So for current tax, so we're going to have current tax here and current tax there. Okay, so it's all the same. The full amount of the grant is taxed in the year received. Taxed in year received. And here again, full amount taxed in year received. Alright, so that's how you treat those two there. And then when it comes to deferred tax, so here you treat the same. So you're basically going to treat this the same as asset-based grant recognized as deferred income. So this treatment here is going to be the same for this one and for this one. So we're just going to write treat the same way as asset-based grant recognized as deferred income. And here treat the same as asset-based grant recognized as deferred income. Okay, it seems like my pen doesn't want to write anymore, but treat the same as asset-based grant recognized as deferred income in both cases. So with that, we've come to the end of the theory part of asset-based grants, where we explain how these grants are explained. So just to recap, we said that an asset-based grant can be treated in two ways. Maybe before we talk of the treatment, we talked about the definitions, and we said an asset-based grant is the prerequisite for a grant to rate as an asset-based grant. For us to account for a grant as an asset-based grant is the process should be used to buy an asset or to construct or to acquire an asset, or to acquire an asset. And any other grant which is not an asset grant will be an income-based grant. So an asset-based grant is a grant used to acquire an asset, to construct or to purchase. any of those. And then we said a grant by definition is any assistance from the government in return for future compliance with certain conditions relating to activities of the entity. And then we had to say asset-based grants are treated in two ways for accounting purposes. The first one is the grant is deducted in calculating the carrying amount of the asset, and then grant is recognized as a reduced depreciation expense. And for current tax purposes, the full amount of the grant is taxable in the year in which it is received. Tax allowances are calculated on the full amount before we deduct the grant. So when you are calculating for tax allowances, remember to calculate them on the full amount before you deduct the grant. Okay. And then deferred tax purposes, we said they will arise due to the differences in the starting date from which depreciation is calculated, and it can also rise due to the methods, difference in methods and rates used for calculating tax and depreciation. The rates can be different. Okay, and then we said that when the grant is repaid, this is recognized as an increase in the carrying amount in the value of the asset, right? And then in the other case, where we recognize the grant as deferred income, that is recognized in profit and loss and on a systematic basis over the useful life of the asset, we said for current tax, the full amount of the grant is taxable in the year in which it is received, and for deferred tax, we said deferred tax will arise due to the differences in tax base of the grant, since the tax base of the grant will be nil as it was taxed in the year in which it was received, but the carrying amount of the grant will be greater than the tax base. So deferred tax will arise due to those differences, the difference in the carrying amount and the tax base will give rise to deferred tax. And then we came to income-based grants, where we said the income-based grants can be treated for accounting purposes in two ways. The grant can either be represented as a credit in the statement of profit and loss and other comprehensive income separately or under a general heading such as other income. That is one way of treating an income-based grant. Or you can treat the grant as, or you can decide to deduct the grant from the related expense. Say you receive the grant in respect of salaries of certain people, then when the company is going to pay those category of workers, they will have now to deduct the amount of the grant before they arrive at the employee expense that they will be facing. And then we said for current tax, the full amount of the grant is taxed in the year in which it is received. And then we said how you treat that for deferred tax purposes is the same as an asset-based grant recognized as deferred income. Okay, so that's just the theory part of grants. Thank you for watching. Let's meet again in other videos.